This has been an extremely frantic week in the markets. I mean, the volatility alone has been astounding. So I'm going to be talking about the Bank of England. I'm going to be talking about Tesco, giving my thoughts on really the overall sales. We're also going to be looking at a few results, including some of my stocks such as BHOO, and also looking at their competitor ASOS, as well as Games Workshop. So first things first, let's jump straight into the Bank of England. Now, the article here in the Financial Times is suggesting they've been accused of going soft on inflation, and this is because they've been raising interest rates by a much lower amount. At the moment, the interest rate of the Bank of England is sitting at about 1.25%, and they therefore raised rates in the most recent rate review by 0.25%. Now, when we realise that inflation is soaring and they're saying that it's going to peak at 11% this year, an interest rate really of about 1.25% is not enough. I understand that in the bond markets, alongside obviously the debt markets, which is a similar thing, well, it literally is bond and debt. But anyway, in these markets, the assets themselves, or at least the bonds themselves, are being priced to a point where they are also looking to curb this, where you can see it raising the mortgage rate yields, especially in America, where it's hitting about 6% at the moment, and it's based on expectations. And we're looking at something like a 3.5% outlook provided by the banks on mortgage rates by the end of the year. So things are certainly on the up. Now, to see that the fact that the Bank of England has increased by 0.25%, whereas the Federal Reserve in the US has increased by 0.75%, this is because the US is a much more stronger economic position. The UK at the moment is struggling. If they raise interest rates too quickly, they may see a problem with stagflation. What will end up happening is that because they're raising the interest rates, that it is going to combat inflation, but also the growth of the economy is going to significantly slow down, and it already is at a very slow level, so they're being very cautious here, hence why they're doing it really in small nibbles at a time. Ideally, I don't think this is enough. They're blaming it on Brexit, they're blaming it on Ukraine. That's a load of rubbish, because realistically they were handing out a lot of free money during the pandemic. I mean, don't get me wrong, I was someone who benefited from it, and I am also grateful for the furlough money that I received, but still, what did they expect? At least own it and say, you know what, look, we as the Bank of England, we gave out too much money, therefore we have inflation. And it's really as simple as that. Now, SoftBank, and we're talking about ARM. So a few years ago, we had I can't even tell you what the company is. Basically, ARM has their own processors, which are in typically mobile devices, and I think they use quite a lot in, I believe, Apple phones. But these ARM chips are more efficient than the previous counterpart, and therefore it was a very attractive business. Now, this was actually bought out from our market, so if you haven't actually been in the UK markets for that long, you may not have known of this company before. But it's been bought out, and then it was attempted by SoftBank. SoftBank therefore wanted to then sell it on to Nvidia in the US. Now, what's happened here is there's competition concerns, so it's been rejected. Now they're on about additional listings and saying, look, we're going to make ARM public, we're going to release it on the US markets, but also list it in the UK. So they're looking to raise a lot of capital here, and my question is, why? I understand that SoftBank is obviously trying to make money, and therefore they're probably looking for some short-term money by listing this company on the markets. They're probably getting themselves access to capital that they may need, and they're looking at a valuation of at least $60 billion for ARM, which is a significantly higher amount than what they would have got from Nvidia, and it's ambitious to say the least. I think when they left our markets in the UK, they were valued at about £20 billion. To now see it this high is quite nutty indeed. Now, Tesco has seen UK sales fall as customers start to change shopping habits. Now, this is primarily online shopping. So you'll see here that their customers have spent 14.5% less online, 0.7% less in the major stores, but their convenience stores have actually seen an increase. And I myself have fallen into this trend where I've been spending quite a bit of money in the local convenience store going, fuck it, I need a meal deal. I'm getting myself an egg mayo sandwich or something, and that's that. It's become very, very tempting because it's a cheaper alternative than actually going and buying something else. It puts more pressure. And I think it's one of those habit-related reasons where I'm effectively going into Tesco and going, right, I'll have a meal deal because it's easy. Whereas if it was a more difficult thing to do, I had to go further to get to Tesco, maybe I wouldn't do it, and maybe I'd save more money. However, what I've got at home, perhaps that's also a shift in it. But I digress. It's a suggestion on the overall economy, although Tesco is the biggest horse in this race with the supermarkets, and it did say that they had gained market share from the other big four chains, such as Asda, Morrisons, and Sainsbury's, but the environment is challenging. I think Tesco will do quite well. They finished selling off their assets in China, well, not China, sorry, but in Southeast East Asia, and therefore obviously they're going to be looking to cut back on operations and return, or at least build as much profitability as possible. And I think the quality of Tesco really is actually quite high. When you look at its US competitors, they have a lot higher valuations, so it does leave you wondering, albeit their reputation is tarnished because they did cook the books a good few years ago. Now into the juicy stuff of the update, and this in particular is BHOO's trading statement. Now, BHOO had suggested, or they'd announced these results, and if I'm honest with you, I'm a little bit disappointed. I didn't think it would be as bad as this, so it's a shame, but at the same time, it's not the end of the world. Now, I've got to be very careful here because I don't want to justify basically see a stock drop and justify why. I don't want to go, okay, look, BHOO's dropped by 20% revenue. Oh, it's fine, the story's still there, blah, blah, blah. I don't want to delude myself because that's not really investing, that's just gambling. And it's also tricking yourself. You just don't gain anything from it except your ego stays a little bit nicer for a little bit longer until the damage kicks in and oh dear, you've lost all your money. In this regard, BHOO has seen their revenue decrease in the 3 months from February to May this year compared to this time last year. Now, when I first read these results, I saw that UK revenue had declined. I'd seen that US revenue had declined, and I thought, well, that's not good. That's really not good. And then I realized, well, actually the comparison period back to a year ago is obviously as we were coming out of the lockdowns, and the likes of the online retailers were in very favorable positions. I also wasn't a fan of comparing to full year 20 because, again, they had advantages, and I think really a comparison period of, 3 years now might be a bit extreme to be comparing. I don't think it's really a fair way of comparing this. I'd love to see a bit more in depth, but I guess that's just your 2 to 3 year like for likes there for you, and there's not much that can be done about it. Now, BHOO's in particular, they've said that their gross margin is down 220 basis points, but overall it's about 52.8%, which is still holding quite strong, albeit I think in 2020 they were on about 55, 57%. It's still good to see that their margins are remaining somewhat resilient. And the UK revenue has obviously declined because it's had such a strong comparison period, although the US one is due to the extended delivery times as we were talking about earlier, and they've actually secured a lease now where they're going to be having their, a new distribution centre in Elizabethtown in Pennsylvania, support its international growth ambitions and transform the customer proposition into a key, blah, blah, blah. What a load of rubbish. I do like their strategic priorities. I think this is key, and I align with it. If I was in a tough time, if I was a business really trying to push and survive and build for the longer term, I would be doing similar investments like themselves. They're not chasing short-term profits, and it can be seen in what they're doing with their stock management, cost management, and obviously their long-term capital expenditure. Therefore, I'm still holding BHOO shares. There's a bit more depth here when you compare it to ASOS. When I initially read ASOS' update, right, I thought, well, it looks like BHOO have actually been hammered here because ASOS have done quite well. Albeit, you look at the results on KK, you know what, look, they've improved their UK total sales. That's quite good. However, you can actually see there's a very discreet profit warning here. And I'm going to jump into Hargreaves Lansdown's stock company news because I quite like it. It's very neutral, it's not biased in any way. It's a good website if you're looking for news on UK businesses, whereas you compare it to the likes of newspapers, for instance, and I don't know if you'll be able to see this here. Let's go onto the full screen. Compared to newspapers such as the Times, they're on about fashions clobbered. You've got Megan Fox there with BHOO, ASOS, THG, obviously the Hut Group. I mean, the fear in these things is ridiculous. And before you go, oh, what kind of news or newspapers do you read? I don't. I fucking hate it. The only reason I've got this is due to the article on BHOO because I thought I'd have a particular read, but media is one of the things that makes a lot of people depressed. I strongly believe in cutting it out. Absolutely. Like I sat there and read like a Metro newspaper at one point, and I was hearing about this poor lass was being obviously killed, and I thought, well, that's depressing. Why am I reading this? It's the same with watching it on the TV. Just cut it out. Stick to the stuff you only need, which will be business news for me, and you will end up having a little bit of a happier time on this earth, and you're not going to be dwelling on all of the world's problems, because quite frankly, if you're only dwelling on the world's problems, you're not going to be a happy person, are you? Anyway, I digress, and no, I don't read the paper. Anyway, so as we were talking about ASOS here, now their profit warning was quite discreet, and it's more specified here. They've now said that their pre-tax profits is going to be somewhere between 20 and 60 million pounds, which is quite below their January guidance, which was about 110 to 140 million pounds. A significant profit warning difference, even though their overall sales have actually risen and their US has performed quite well, likely because they do have distribution set up, but all for it. If they're able to continue that growth in the US, and they're doing very well indeed, albeit it's a much smaller revenue share compared to obviously the EU and the UK, whereas BHOO obviously has a lot more in the UK and then the US. So it's an interesting one there. But ASOS did end up dropping about 30% intraday, which was savage to say the least, but one obviously to be following. Games Workshop, as per usual, they go into their in-depth detail on really what's happening, and they really give a lot of excessive language, really break it down in about a 200-page report. No, I'm kidding, because Games Workshop, they've had a trading update and they've got about 2 sentences, as per usual. Legends. Now, they've mentioned here that their revenue is not going to be less than 385 million compared to 353 million this time last year. Royalties, however, are higher at 28 million pounds compared to 16 million pounds, suggesting here, okay, well, they're getting more in royalties. Is that a good or a bad thing? Well, it's good because a lot of that earnings do turn, or the revenue turns into earnings, but also at the same time, if their revenue is not really that much more ahead, or at least their earnings isn't, then it's saying that actually they're selling less of their inventory, they're shifting less of it, they're making less money on it, and that obviously isn't a positive sign indeed. But they are holding their PBT quite well, so I suppose that is a good thing overall. But then with royalties being more popular, that suggests that their branding is actually becoming stronger, and therefore a good thing overall. They've also mentioned that the dividends has stayed flat at 235 pence per year, and I run the figures on this, and it's something like a 3.8% dividend yield at about £62 per share, and they're looking at a price to earnings ratio of about 16-17 times at that price. So it is very strong, and I think it's a good deal at the moment, and it's one that I'm interested in. So going forward, I will be purchasing a bit more Games Workshop here in my portfolio. As you can see, I at the moment have no cash, but I will be planning to add more, and I'm just going to be chipping away. I'm going to be averaging down on BHOO, as I have done. I'm going to have to average down quite substantially, so probably about 66 to 75% of my attention and my capital is going to go into BHOO. But I'm also going to be topping up Games Workshop as well, because I do think they are a good business. And also in my self-infected personal pension, then not quite the case. And here's obviously the proof of the savage volatility I've had in my ISA. I mean, hell, you just need to look at that 1-year graph to see how much that has been absolutely caned there. You can see that there, and it's got a slight little bump, but it's not enough. And in the self-invested personal pension, I've now used up all of my cash. I've bought more shares of Dunelm Group, I've got more shares of Kingfisher, and I'm just going to let the dividends come in. I'm just going to let them flow through and see how it goes. I do have a comment of the week this week, although I'm going to have to quickly source it, so bear with me. So this comment's quite far down here, because this is my held for review comments. Typically, if they're a bit offensive, they'll get held, or if they're straight up spam, they'll get held as well. I don't know why YouTube doesn't block it. Clearly, they don't care enough, because there isn't a big enough incentive for them to block the spam, because quite frankly, it'd be very, very easy. But again, it's not in YouTube's interests whatsoever. Regardless, GFG has said that you are a naive investor with no expertise. I've never claimed otherwise. I started investing at the start of the channel. I don't preach to know more than what I actually know. People listen to your shit and assume you have some brains. Well, if they do, I'll take that as a compliment, but I don't really think this is how... I'm not trying to push this on. It's not really what I'm after. But you're saying this means you not only lose, but you also destroy value for others. Good, this is the end. I don't think GFG was very happy about that because, basically the video I said where it's time for change, he says another round of BS coming, you can't even stick to the end for one day. So this person here is obviously very happy with the content I produce on YouTube. I don't preach or pretend to have expertise in the stock market. I learn from my mistakes, and I hope that you can do the same thing. Yes, I'm down over 50% in my portfolio. Take that and see it. At least I'm showing my returns. If I wasn't showing my returns, I could be lying. I could be saying, oh, look, I'm up 200%, and you wouldn't know any better. And then would that not be more malicious, people listening to that and thinking, oh, wow, this Ozbourne Foreman person is a fantastic investor, listening to it, blindly following the trades, and boom, even more people have lost money. If people see me lose money, it's probably a good thing, because they'll see that, they'll go, okay, that's exactly probably not what I should do. Learn from his mistakes and do better overall. Don't blindly follow someone, and especially because I show that I'm down 50%, people are not going to blindly follow me into trades, and that is absolutely fantastic. But if you're going to sit there on YouTube and just go, right, I'm going to copy someone or some individuals, just investments, flat, even like influential investors, we're talking Warren Buffett, Charlie Munger, you can't do that, because quite frankly, their reasons for investing are different to yours. Their investment time horizons are also different. You can't base your investment based on who's bought it, because again, you don't know their motive. You don't know when they're going to get out. You don't know what price really they're going for and what they fundamentally valued the business. A good example would be, let's say, Alibaba. You saw Charlie Munger had held it, or something like that in his Washington Post, and you'll be like, well, okay, yeah, well, Charlie Munger's bought it, I'm going to buy it now. And obviously, he's cut down his stake since slightly. But you've gone in and bought, well, Charlie Munger's a great investor, I'm going to follow him into it. You haven't done your own due diligence. So when the stock's up, you don't know why. And when the stock's down, you don't know why. It's all about that understanding. The more research you do, the more work that you do and put into your investments, the more you can learn. And the more you know about the stock, it means you can go, okay, look, Boohoo's down 20% today. This is why. This makes sense because guess what? I saw it coming almost because I saw that there was inflationary pressures. I saw that their delivery times were extended. Therefore, it's very natural that their revenue is going to be declining alongside their profit margins with the higher returns rates as specified in the newspaper below. So again, I'm going to preach this. Absolutely do not follow any influencers or anyone that is seen to be quite good at money management, because they have different reasons to you and they'll sell for different reasons as for you as well. Have a fantastic day.